Are you looking to invest in the Perth property market and want to use a local buyer's agent to help you secure your next investment? Mitch and Sam are the co-founders of SJR Property Group, a buyer's agency based in Perth that specialise in helping investors build property portfolios that outperform the market. Check out www.sjrpropertygroup.com.au to book in a free discovery call and chat with a local buyer's agent today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well, enjoying the April. We've had up in Sydney over the Easter period, some fine weather. Now we're sort of moving into 2 weeks of rain, I'm told, and it's just started raining outside and it's got to be torrential coming up this weekend. But I do enjoy quite wild and wet and windy weather. And it's just a sage reminder that much like your property portfolio, sometimes the sun is shining and everything's great. And then at other times, storms are looming and there's challenges and problems ahead. And I think a lot of investors have gone through that over the last period of time with rising interest rates, trying to recalibrate their portfolio with the much different costs to hold it, serviceability constraints because lenders won't lend as much as what they used to because of the interest rate environment and uncertainty about what the future looks like. But even today, numbers come out from CoreLogic, and I think the numbers were about 1.3 or 1.6% increase in national price values over the last quarter, the March quarter. So despite all of the headwinds, property values continue to march on, and it comes back to that same question: would you rather be in the market or out of the market as a property investor, considering all of those things you need to balance these days? And when you see the continued price growth with property, those quarter numbers are okay, and you're able to hold. This is how you get long-term value creation with your portfolios. What we chat about on the Smart Property Investment Show is my job to bring people into the studio to see what they're doing in property, whether they're property professionals helping Aussies do it or they're property investors themselves. And this comes back to the core and the heartbeat of this podcast and why we set it up, is chatting to property investors. Today I have Henry Tilley in the studio, a long-term listener, first-time podcaster. I'm heard he's a property investor. He's got a question mark about what he's going to do next. We're going to have a chat about that today, and we'll sort of unpack his portfolio as well. Henry, welcome. How you going?
Oh, going very well. Thanks for having me on your show, Phil, and pleasure to be here.
No, it's nice, mate. So we're dialing in. You're in Sydney. I'm in Sydney, but we're over the marvels of Zoom. How did you end up finding this podcast? You've been tuning into it for a little while, yeah?
Yeah, that's right. Just my girlfriend listens to all the podcasts, and I thought I'd see what's out there in terms of sort of property investment content, and yours came up pretty quickly, and it really resonated with me. And yeah, I've gleaned a lot of really good insights and been sort of tracking some of the conversations you've had, particularly with like Scott O'Neill and others. And yeah, I've really enjoyed it. So shameless plug.
Well, there you go. I'm happy. I'm happy for a shameless plug, but thanks for the feedback. You know, it's good to know that what we do here actually helps shape positive investment decision-making for property investors as they get down a pathway of wealth creation. Did you start listening to the podcast before you started investing in property, or you're investing in property and then found the podcast?
Yeah, the latter. So invested in property and then to discover the podcast. I sort of found that there's a few books out there which are worthwhile reading, but it's really down to conversations and people who are living, I think, relevant insights to those who are trying to build a property portfolio. And I think podcasts are a great channel to get access to those conversations. Yeah, nice. Particularly for someone like me who's not from a property background. I don't work at a commercial property firm, or I'm not a real estate agent. And it's just been very helpful to kind of accelerate that sort of that knowledge sharing.
So Henry, so you're a property investor first, and before you stumbled onto the podcast, when did you start investing in property?
So I bought my first apartment in July 2022. Just in terms of how I got there, so really at the beginning of the journey, like sort of chapter one, like I haven't got 10, 20 plus properties. So I really, when I grew up, it was very much a traditional pathway: go to university, secure a full-time job, trust that super will grow, and so will your salary, and all kind of work out. But it kind of got to a point where I just sort of felt like it wasn't growing as quick as I'd hoped. And there's a lot of sort of things you want to try and achieve in your sort of early 30s. And I think just sort of needed a wealth creation strategy that was a bit quicker than than that sort of pathway. So I sort of spoke to a couple of people, and one of them really stuck out was having a chat with my uncle who did really well. And he was saying, try and borrow as much as you can and to look to leverage and try and ensure that asset can cover the cost of debt, which was his advice. So I thought about that a lot. And, there's like margin loans out there for stocks and personal loans, but really property was like the one that really came across as the asset class and as the opportunity that really, really spoke to me, just given how much the banks are willing to lend to you and also the ability to borrow against it for further purchases. So that was pretty exciting. So I sold a bunch of shares, had some cash savings, and just put up a 20% deposit for a one-bedroom apartment in Mossman in 2022. It was for a price of $680K, locked in a 2-year principal interest loan at 4.39%, which finishes up in July this year. So pretty vanilla stuff. I just really wanted a very pretty safe, conservative first property, looking for a small strata, red brick, 1960s apartment building, no pool, no gym, no expensive lift. And that was the first purchase. And, made full use of that first home buyer scheme, which had minimal stamp duty up front, which I think it was about $5K in stamp duty versus about $26,000 if I was to do it without using that scheme. But the catch was I had to live in there for a year to make that viable, which I've now done. And I've since moved out and live in a different suburb with my girlfriend, and turned that property into an investment property, put a tenant in, and kept it going. Yeah,
sounds pretty sensible, and no doubt that property's probably performed pretty well for you in Mossman.
Yeah, that's right. Yeah, I was able to sort of read a lot more, and I was able to pull out about 120 grand in equity from that property, and that was a big part of the second purchase, the second investment property that I made late last year. Yeah.
So the Mossman properties propelled you into a second property. And when did you buy Mossman? 2022, was it?
Yeah, July 22.
Okay.
Yeah.
And when did you refinance it?
About October last year.
Okay.
Yeah.
So you sort of manufacture 120 grand in equity over a period of 14, 15 months, did you?
Yeah, that's right. It was, I spent, to get that first deposit took about 7 years.
Mm.
And then suddenly I've got the same amount of deposit in, about just over a year.
Did you just sit there just going like, I've just made, well, you've got to pay interest rate on the capital value that you've manufactured, but you sit there and just go, wow, this is the right way to make money, right?
Yeah, and exactly. I was just blown away by how lucrative it can be, and just kicking myself I should have started earlier, which I'm sure you hear quite a lot on the show.
That's what all investors say. We should start earlier. Well, I guess for you, the positive thing is that you've had this realization that a lot of Australians are still subscribed into this idea of the Great Australian Dream, and that is you get a good job and then you buy a house to live in, and it's right to buy a house on a quarter-acre block. There's a lot of Australians still subscribing to this idea. And then you've sort of looked at it very differently quickly, going, well, yes, my superannuation will be there in retirement for me to live probably very differently to how you're living right now. So you need to take control of your financial future. So investment property is one way that you're doing that. But you're now gone from one of these young Australians struggling to get on the property ladder and saving for 7 years to get a home deposit, and whether or not you're one of those very vocal people you hear right now complaining about the death of the Great Australian Dream. But now you're a property investor and you're down this pathway of looking to now own multiple investment properties. Did you ever subscribe into this idea of, housing is a right rather than a privilege and every Australian should be able to own their home? It's a bit of a loaded question.
I just suppose I was surrounded by people who could only do it with a lot of parental assistance, and it always felt that it was just really beyond the reach of someone with above average salary. It's really hard to get into. And I don't think I had this ideological need for the quarter-acre block, but it's pretty hard.
Well, it's hard, but look what you've purchased as your first home, and yes, you lived in it for a year, and that was to, tap into a lot of the benefits that the governments and state and federal provide for first home buyers. You bought a 1-bedroom apartment. You didn't buy a 5-bedroom mansion out somewhere in the burbs of Sydney. You've bought it half of the median price, or the standard median price in Sydney. So, it is available and it is accessible for Australians if they go around it the right way. You didn't buy your forever home as your first home.
Yeah, exactly. I sort of bought what I could afford. It was a very vanilla 20% deposit. I now know that you can do 10%, etc. But at the time, I knew the area. Land there is scarce. I just felt like I could put a tenant in pretty quickly once I exit. Yeah, I just did what I could at the time.
Yeah, no, and what you've done is, inverted commas, quite vanilla and boring, and they're some of the best investments because it's now got you on a pathway for growing your portfolio. Let's dig in a little bit further. We'll just go to a quick break. Everyone stay with us. Back in a moment.
Are you looking to invest for a big return, but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 report for 2025, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
Welcome back, Phil Tarrant from Smart Property Investment. Having a chat with Henry Tilley and his pathway as a property investor, now 2 properties and thinking about his. So you went to uni, you're a professional of some sort, Henry. What do you do for a quid, mate?
Yeah, I'm 33. Yeah, went to uni, been working full time for 10 years, 11 years now. I work in government relations at an energy company. Used to work at KPMG before then and worked for, I guess, as a political staff or worked for a minister in the former government, which was a bit of fun.
Were you a former staffer? Were you federal or state?
State.
Yeah. Okay. And so government relations is something, you probably see a lot of the goings on of how policies are set inside of political or government departments. So you sit there sometimes and get frustrated. Now you're a property investor going, wow, a lot of the times that decisions are made and the next committee is set up to work out what they're going to do with right and the wrongs of the last government. It's just madness sometimes, isn't it?
Yeah. Well, I mean, I feel for Labor now in government. They've been on the opposition benches for a long time, and the weight of actually having to make decisions is pretty heavy. And I suppose when I worked for the minister responsible for building construction legislation, and a lot of the complaints that were coming across his desk were about new apartment buildings and off the plan, and all these poor owners and first time investors going, oh, the builder hasn't done this, or this is not what I thought I was buying. And and seeking recourse from government. And that was a big reason why I went for a very conservative red brick 1960s building, because I didn't want a bar of that kind of the new build.
Well, you got the benefits of those experiences. And, there are certain cohorts of property investors who think that they need to be buying a brand new apartment somewhere that's been built by one of these large organizations. And, sometimes it's not always the best strategy. I know some people have done well off the plan apartment purchases, but I mainly hear bad stories rather than good stories. And I'm not giving a particular view on that, but I sit there sometimes and go, people still make the wrong investment decisions based on smart marketing or a slick salesperson or chasing government incentives, or it might be because of their visa status or whatever it is, right? But you've gone down a pathway of just going, let me get something which is just, no doubt I could probably imagine what this place looks like. I know the area in Mossman, super vanilla, and it's paid dividends because you've been able to extract equity out of it. So you've bought another property subsequent to it. Where was that and what was it?
So I got pretty excited after reading Scott O'Neill's book about commercial property.
Okay.
There's some really good passages in there about the advantages of leverage and why commercial can be a pretty compelling proposition. You got this positive net rent, much longer lease terms. Yes, it does appreciate in value. You're buying into the Australian economy, which is, I think, a good thing. So I read that with great interest and pulled the equity out of the Mossman apartment and went and secured a loan for a property in Melbourne, sort of sort of the eastern suburbs of Melbourne. It's a little office, 118 square meters, with a really good tenant. It's a not-for-profit that's been in there since 2018. Settled on the place in February this year. Bought it for $480K. Yeah, and it's positive cash flow. Lease runs through till end of next year, and there's a lot of talk about office space, but I thought this was a good tenant, and they're not going anywhere, and if it only take about sort of 3 or 4 months, I think, to find a new one if they were to vacate at the end of the lease, and I got the cash on hand if that was to happen. Yeah, I thought it was a good little investment. And
So it's putting money into your back pocket, even with interest rates where they are right now. Did you finance it at 30, 70% or 80%? It's probably 70%, was it, being commercial?
It was 80%.
80%. Yeah.
Yeah. And its yield is 8.2, I think.
Okay. And the tenant picks up all the repairs and maintenance and all the costs connected with holding the asset?
That's right, yeah. It's all taken care of. Yeah, so that's kind of ticking away. I mean, it's only just gone through about a month ago now, so pretty fresh. But I think
we'll see how it goes. So when are you going to start lease negotiations with them to renew their lease? Pretty soon, I hope.
Yeah, I think beginning of next year, I reckon I'll be saying, "Come on, what do you want to do here?"
You've bucked the trend. Normally, a lot of investors would load up with a little bit more resi property before they sort of start chasing commercial. Any reason why you shifted so quickly and look at these commercial assets? Was it mainly chasing cash flow or positive cash flow?
Yeah, it was positive cash flow. And my next one I'm trying to do now would be residential. I just felt that the interest rates being what they are, I just needed all the help I can get to service the debt. And I thought this was a good way of doing it. And wouldn't mind your thoughts on this, but I called up the valuer who did the valuation for the bank, and he said it was a good deal. Everyone else told me it wasn't. My lawyer was pretty, you sure you want to go into Melbourne? Or land tax is pretty high. And is this really what you want to do? And so I had to push through that. But the valuer said, yeah, you did it. It was a good purchase. He reckons with around 5,000 a square metre versus 4,000 a square metre, which is what I purchased it for. So that's one opinion, but it sounds positive.
Well, time will tell. You don't know. You've knocked around government a fair bit. The Victorian government's still trying to work its way through its most previous premier and some of its decision around COVID. But, speaking about those numbers coming out of CoreLogic, I think Melbourne was the only place that went backwards in the last quarter. I don't know. Commercial property is a bit different. But time will tell. The thing with positive, if it's tenanted and you've got positive cash flow, it's a lot more forgiving. It's when you've got to start sort of tipping into a property where you start questioning whether or not it was a good purchase or a bad purchase. But time will definitely tell, and no doubt there'll be some tax implications for you. Did you buy it in your personal name, or how you bought these properties?
So the first one was in my personal name.
Yeah.
But the second one I bought through a trust.
Okay. So you set a trust up, did you?
Yeah. Yeah. It was about $2,000 to set up. Yeah. It was all through a trust. Yeah. And that was for the rationale of not sort of hindering any further purchases. That was the advice I got.
Yeah. And you keep your powder dry a bit as well. So do you currently rent? You don't have a principal place of residence?
Yeah, currently rent, or rent vest, or whatever they call it.
Yeah. Even if you move back into the original place that you purchased as an occupier, you could still, no doubt you've spoken to an accountant and how you could maximise that with potential around capital gains if you choose to sell it. But, you've got a lot going on. You've moved into commercial pretty quickly. You're already investing in a trust quickly. You've got a good accountant or accountant that's sort of advising you?
Yeah, I reckon he's pretty good. Yeah. He's done all right so far.
Knows the way around property a bit.
Yeah, exactly. Yeah. No, I've been impressed with what he's done. Had a good broker. I would say for those starting out that there's a lot of variability in broker advice, and I'm on to my fourth broker for trying to lock in the numbers for the next purchase, just given how different the valuations and advice that I get coming back to me. So I had to persevere pretty hard to try and lock that all away.
Well, everyone needs a good mortgage broker. So let's chat about next purchase. We've got another break. Henry, just stand by, everyone. We'll be back in a moment.
G'day listeners, Sammy Gordon here from Australian Property Scout. If you're loving all the property investment content over here at SPI, you will love the Scouting Australia podcast. Hosted by myself alongside my good mate and experienced investor Jimmy Ibrahim, we unpack everything from real investor stories, mindset hacks, and a massive amount of property investment strategies and much, much more. Check us out over at the Scouting Australia podcast and take your investing to a new level.
Welcome back, Phil Tarrant from Smart Property Investment, chatting with Henry Tilley. Now, you're getting set for the third or the next purchase. You're currently full-time employment. You've got a partner. You're not married, or is that all down into the? Not that you're probably tuning into this, so you don't want to give too much away. But what's you've got other expenses that will probably come into your life at some point.
That's right. Yeah. Happily, I've got a lovely girlfriend, but. Yeah, marriage is probably not far down the track.
Well, there you go. Good. So there's and which is money well spent, by the way. It's probably the best investment you'll ever make. But so you've got to sort of balance these sort of the priorities of life with trying to manufacture wealth running in parallel with that full-time work? You're not going to go back to government, are you? You're quite happy where you are right now? I don't know if your boss is tuning in.
Well, I think the map's pretty red at the moment, so I don't think they want me just yet.
No, well, I did notice. I was reading the paper this morning. The Minns government is changing a lot of this sort of town centre stuff going on right now and building out whole new areas away from public transport. And there's a lot of discussions around it. They reckon still, I don't know what you saw when you're in government, the development application process is still an absolute nightmare. I can't remember the term or phrase that they used, but it was like building a house without a door or something or other. That's what I read this one. I maybe saw the papers. You got all this stuff around the need to increase supply, but the bureaucracy around it is an absolute nightmare. I can't see that changing at any point in time. I don't know what your view is on that, Henry, with a view towards the way the political departments work.
Yeah, well, it's this constant battle between the secretary and the minister, and I just hope the minister can really push ahead and create more supply for the demand, and I'm sure they will. There's a good team supporting Chris Minns, and I'm sure it'll be fine.
Yeah, there you go. It's very political, a very politically orientated answer. That you saw what he did with maybe a career in politics for you at some point, Henry. So government relations, government relations, interesting. So you work for an energy company, no doubt, trying to get the most favourable conditions for supporting energy growth in Australia, which is a big issue. But full-time employment is key. I guess, it's pretty hard as a youngish sort of professional to manufacture more money from your employer. You can always ask for a pay rise, but it doesn't really move the needle when you consider what you can do if deploying the money that you make it work into property. So what's next for you? You're working with your broker now on the next finance. Is more finance available for you? Are you able to sort of take on more debt?
Yeah, just going to full-time work. I think probably the hardest way to make money, it would be these high-paying executive positions that you're told to shoot for early in life. I think there's got to be other ways of doing it. So I'm trying to work through seeing if I can do a residential property valued around $450K, so pretty entry level, using the remainder of the equity in that first Mossman place, and then looking at somewhere like a little, probably a one beddy in like Newcastle or Wollongong, or do I go further afield like Perth, Western Australia, or go to Brisbane? Still working it through. So I just want to get the numbers before I start doing the research and finding a deal.
Well, it feels like every investor's in Perth at the moment around that price point. We just launched a Fast 50 report, and there's a lot of price points in suburbs there, but good luck trying to skewer something because every property investor in the land's out there at the moment.
Yeah, but it's only just shot up in the last year or so, hasn't it? I mean, it's been pretty flat for quite a while. So.
Oh, but for a decade, nothing happened in Perth. People were buying properties 3 years ago for the same price that they were buying in like 2011. So a lot of investors sort of got into that market at the peak and had to hold property for 10 years waiting for something to happen. And that's the way that property sort of goes. So when you refinance the Mossman property, so you refinance at 80% of the value. So that's, I would imagine, negative cash flow on that property with the increased debt.
Yeah, it would be a bit of a gap that I've got to service from salary, and I can get a little bit from that commercial property to initially fund the difference as well.
Yeah. But then there's negative gearing, right? So you're one of the, if you listen to the Greens housing spokesperson, you're one of the people gouging the Australian political or gouging Australia out of its tax receipts because you are one of the negative gearers right now. But, this is the balance you need to have as you grow your portfolio. Negative gearing is something we have in place as, Australians that provide or in the business of providing residential accommodation for people. So it certainly is a business. And I think what is critical is elements of the property sector or even the political class need to start, reframing property investment as being it's something for mum and dads. It's not. It's businesses for providing rental accommodations for Australians. And that's what it is. It is a business. Hence the reason why if you are running a business, you can claim deductions from it. One of them is interest repayments, certainly being demonised lately, and I think it really needs a reframing. But this is a podcast for property investors, and no doubt everyone sees and tunes into this, see the benefits of negative gearing and look to balance their portfolio to continue to provide rental accommodation for Australians with the benefits of how they can maybe get some of those tax benefits from it to continue to invest in property in Australia and provide rental accommodation for Australia. So is your accountant sort of giving you this advice on, how much positive cash flow you need in one property versus, negative cash flow in other properties? So you can, to your uncle's point, take on as much debt as possible so you can buy as much property as possible.
Yeah, I'll definitely ask the question, Phil. So as soon as I get heard from the broker, which should be this week, actually, I'll definitely go back to the accountant and say, look, what's the forecast here? What's the next 2 to 3 years look like? So I can just map it out accordingly and make a good decision. I'm also looking at the self-managed super fund options. So I've set up my own super fund and closed the industry account, which was a lot of paperwork. That was quite a lot of barriers to push through there. But
they make it easy, right? It's not like they want to try and hold on the money for you, do they? You wouldn't think there was anything untowards there.
Yeah, it's unbelievable how hard they make it to access your own money. But I've got and done that. I've got about 142K sitting there.
Okay.
That I want to put for a deposit for investment property under that structure. So yeah, again, with the brokers to sort of see what's possible. But I'm not expecting, and you would know more than I on this, not expecting a 10, 20% deposit. I would probably have to be a higher LVR, I'm assuming. But anyway, we'll see what he says.
If you're buying resi in your super fund, you sort of get 80% LVR. So yeah, you can deploy 140 grand. We'll get into the market. Maybe some of those cheaper suburbs out in Perth. I know a lot of Aussies are now investing in super inside of their super in Perth at those sort of price points. Again, it's a question for your accountant whether or not it's the right thing to do. But you've set the fund up. There's this sort of misnomer that you've got to have $200,000 in your super fund in order to make it worthwhile. Where that number has come from, maybe retail and industry funds who would rather Australians keep their superannuation in those funds come up with that number to try and persuade Australians not to set up their own super fund. But it's a huge asset class now, self-managed super fund investments. It's certainly competing against retail and industry funds. And, I went through the process of going after a number of years of less than 1% returns inside of my retail funds of going, stuff this, I could certainly do this better myself. So no doubt thinking the same way. So you've got sort of two options there. You've got self-managed super fund purchase and also investing outside of super. So there's potentially 2 more properties on the way at some point soon. That's pretty cool.
That's the objective. Yeah. Next couple of months, I reckon I'll got a buyer's agent for the next residential property.
Okay.
I thought that would be a good thing to do. It's about 15K.
Why are you choosing to use a buyer's agent rather than doing it yourself?
I just wanted to see, just for a greater deal flow, just wanted to sort of see what they can offer and help with the negotiations. And especially if it's a Brisbane or Western Australian market, that if I decide to do that, then I'm based in Sydney, so I'd welcome that local knowledge and happy to pay for it. But yeah, if it's a Newcastle or Wollongong, maybe it's a bit of a less of a rationale to forego 15K your own money.
Yeah. Well, it's good to have the right advisors and people on your team to help sort of shape your decision making. But you sound very proactive, Henry, with it all. And you're starting off reasonably young, investing in property. You think about you've been at work for 10 years. You've still got at least another 3 decades of work ahead of you, mate. Maybe 4 decades. So not to depress you, but but you think about you've got 4 decades of work ahead of you, 3 to 4 decades of work ahead of you. Which sounds quite daunting. That's a number of market cycles that you're going to go through. So just starting off, albeit even, you probably think it's a big deal what you're doing right now, and it is. But, as you go down that march of investing in property, you'll look back to these early days going, oh, wow, I don't know why I worried about that. I should have done more. You will do that. And that's the mark of a good investor, right? That you've made all those right decisions. But you think of the market cycles that you'll be able to go through as an investor and the upsides from that. So, mate, best of luck with it all. You have to come and report back once you've made these next couple of purchases in and outside of super and let us know what you've bought and how you've gone.
Yeah, sure. Happy to. Yeah. I mean, they're just entry-level purchases and hopefully I can scale it up and go for some higher quality commercial and some more desirable residential in a couple of years' time. But you got to start somewhere.
You've got time on your side, mate.
Yeah. Doing what I can.
Yeah, and you don't want to push the boat out too far. But what you're buying now are sort of foundational properties, right? Which you'll leverage into other stuff moving forward. When you've been doing it for a little while, you can start looking at different asset sort of levels and different types of property and, maybe more commercial, whatever. But you've got to get the basics right. It's the first couple of properties that you buy will determine and dictate how successful you'll be as a property investor. And you need to remember that, look at ATO stats, most Australian property investors, it's a huge number between 1 or 2 investment properties. So, the people that tune into this podcast typically aren't those people. And the reason why most property investors only own between 1 and 2 investment properties is typically they buy the wrong property first and second, and it just sort of caps them out, taps them out. So I don't think you're one of those people, Henry. You seem to know the game, mate, so keep at it. It's good to see you doing it so well. Do you think you'll stick with government relations as a career path? These things can move into many different things.
Yeah, indeed. I love the property to become more and more, taking up more of my time and hopefully make that a full-time career at some point. I love that to be a reality, and can I do some syndicates for some bigger purchases down the track?
Do you know the easiest syndicate you can do?
Oh, yeah? What's that?
Get married and do it with your partner, because that's a syndicate, because then you've got 2 incomes tipping into serviceability. Most Australians invest in syndicate. They invest as a couple.
All right.
That's all the syndicate is. It's multiple people participating in a property transaction. The syndicate might be, you might get 4, 5, 6, 7 people, whatever it is. But most Australians invest in a syndicate. Most Australians, have multiple people on, at least on the debt, maybe not on the title, but they get the benefits of pooling 2 incomes. It's a syndicate, mate. Not that I want to sort of advocate and accelerate that for you, mate. I'll let your partner tune into this and you guys can work it out. You can be a marriage of convenience, so you can do a syndicate, mate, rather than the other reason. But it's a really interesting way to view it, mate, if you want to keep investing in property.
Yeah, no, that's cracking advice.
It's not advice. It's not recommendation. It's just my humble view.
Anything else how's that plan sounding like? Is it sort of resonating? Anything else I should be looking at, or any kind of tweaks from your perspective? Someone starting out?
Yeah. Well, you've started out, and that's probably the most important thing. I think that first property you purchase in Mosman is sensible. It's pretty hard to get that wrong, to be honest with you. And just say if everything fell apart, you'd be able to sell that tomorrow, and you'd probably get your money back on it. But it's already sort of growing in value. I know that area pretty well. You're not going to go too bad. So it's a good foundational asset. Yep. Whether or not you will hold that in 3-4 years' time, I don't know. It might be one of those things where you go, well, it's served its purpose. I can actually leverage that into different assets moving forward. Wouldn't be surprised if that happened with you. The fact that you're actually getting, when you're paying for advice using sort of a buyer's agent account, I think that's, it's not a bad pathway to go down. You just want someone in your corner who is connected and committed to helping you make more informed decisions. I think that's really smart. You always look in hindsight at your portfolio and go, I wish I did more when I could have. Nice point in your life where you don't have too much responsibilities, right? So it's okay to push the boat out a little bit. So the repercussions of getting it wrong, you've got time on your side to remedy it. But you're educated, you're educating yourself, you're investing in your education. That is probably time, energy, and effort to sort of read books and listen to podcasts. Mate, you're doing a lot of the stuff right. And the key thing is to set yourself down a strategy and don't sort of deviate too far from it. Like tactically you can do things and tinker and tweak, but when I see people as they get more educated in property, they go, oh, I'm not going to do that anymore. I'm going to do property options, or I'm not going to do that anymore. I'm going to become a developer, or I'm not going to do that now. I'm going to do this, or I'm not going to do that anymore and do that. They fundamentally change their strategy every 6 to 12 months. And often, that can be fraught with some perils, because if you get it wrong, you get it wrong. Property is easy. Property should be easy. Property shouldn't be complicated. Property should be boring. Property shouldn't be too exciting. It's just get the basics right. And they're the building blocks of getting you into a position in time where you can go, oh, well, maybe I could start looking at different assets, right? And you've got to wait. Strategic patience is a key thing. Sometimes the benefits is just to wait and do nothing. And property, if you buy the right stuff without sort of pushing yourself out too far in terms of debt, probably can be quite forgiving, and time is your friend. So I'd stick with that, mate. Don't overcook it.
Yeah, I mean, the best plans are simple, really. And I think a lot of people conflate complexity with sophistication, and I just don't think it applies in this case. And it is a bit of a delayed gratification game. Like, it's strange forking out thousands of dollars for legal fees and setting up trusts and putting 1% deposits down, and where you can spend that money easily on a holiday or nice dinners out or whatever. So it does feel a bit strange at the moment, but what does it matter? Like in 6 months, 12 months time, like, thank God you did it, right? So
yeah, and it's the challenge that we have today is that We live in one of the great countries of the world with major cities. You know, if you export Sydney or Melbourne into America, I think they'll be the fourth and the fifth biggest city in the USA. They're big places. They're globally attractive. The property markets operate in particular ways comparable to your Londons or Tokyo's or New York's, or choose your major capital of the world. If you want to participate in property, you've got to think about things differently and don't have this expectation of the right entitlement of everyone owning a house for the Great Australian Dream anymore. That's not the way it works anymore. And if you want that, that's fine. You might not necessarily be doing it in Sydney or Melbourne or even Brisbane moving forward. So this is the challenge. But property investors can take control, and you're certainly a case study in the fact that property is accessible if you do the right things. But there's got to be some compromise with that. You might not have your big, 2-year holidays. You might not be flying around the world sort of visiting places for Instagram photos so you can show your friends how great your life is, right? Like horses for courses. Choose which one you want.
Yeah.
Yeah. It will come. Like maybe in time, you get the benefits of a nice big fat property portfolio, do that sort of stuff. But I'm of the school of thought, often you've got to choose one. You can't have two. If you want to be a property investor, you want to invest in property, you want to own property, you want to grow your property portfolio, choose that. Because if you do that, you're probably for some time not going to do the other stuff, and that is going on holidays every weekend, living in the centre of Sydney because that's where you want to live, dining out every meal. Like, choose one, and both of them are fine. Best people I know, they choose one and then they go, okay, I've done that, I'll do the other. That's fine as well. That's okay. But often you can't have both. So, but if you choose one over the other, they both have their positives and their benefits. So
yeah, exactly.
I think you'll sort out. Well, come back, report to me how you go with the new purchases, mate. Best of luck with it all, and thanks for sort of writing into us to come and have a chat with us on the podcast, Henry.
I appreciate it. Thanks for the chat, Phil.
Yeah, nice one. We'll get Henry back on and he'll tell us more about what he's doing. So remember to check out smartpropertyinvestment.com.au. I spoke about the Fast 50 report. Go and check it out. You can download it at that website there, and find us on social media if that's how you like to connect in with stuff. See you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.